Hi, and welcome to this week's Money and Markets Squawk Call, where we go around the horn with all of our editors to give you their insights on the happenings in markets for the week and beyond. It's Tuesday, June 17th, and joining us on today's call are Larry Edelson, Mike Larson, Doug Davenport, and Mandeep Rai. All right, good morning, everyone. Certainly no shortage of potentially market-moving events to discuss on this call. Of course, we've got the prospect of civil war now in Iraq, which is nice to know. A little bit more than a decade after the U.S. invaded there in the name of regime change. Guess what? We're sending troops back to protect our interests in Baghdad. Just to kind of ties into what you're always talking about, Larry, in terms of the winds of war blowing harder. Why don't you tell us what you think the impact will be on this mess in the Middle East on markets?
Well, the cycles of war have been ramping up for a few years now. I've been reporting on them. War is part of human nature as anything else. It has cycles just like the seasons of the year, etc. And I've been studying them for a long time. Even studied warfare amongst primitive economies back in college as an anthropologist. And I forecast that the cycles of war would pick up starting in 2012 and start accelerating. They don't peak until 2020, and they've been right on the money. We're seeing a complete ramp up all over the globe of social unrest, domestic unrest, civil wars, and even international tension. But the important thing to understand here is that it's global in nature, and to look for the common threads. And the common threads, whether it's a jihadist movement, whether it's what's happening in Iraq or whatever, is it's really the private sector against the public sector. And that's really what's going on. You can call them religious zealots, whatever. But they're really rising up against authoritarian and dictator-type economies, corruption, the imperialistic West, which, over the years, over the decades, has really pillaged a lot of Islamic countries for natural resources. And, right now, the only reason Obama's going to send people back to troops back to Baghdad is to protect our oil interests. It's all about money. So whether it's, again, jihadists in the Middle East, or it's an uprising in Ukraine, or an uprising in Thailand, or in Europe, or what will eventually come here to the United States, you're already seeing the nutshells, the seeds being implanted, if you will, with the Tea Party's victory over Eric Cantor. This is the common thread, private versus public, the private sector versus governments that have engaged in bad economic policies for decades. And it's a revolution that's spreading. As far as the markets go, I think it'll have the impact that I've been saying all along, which is it's going to drive U.S. equities after a pullback, which has started, through the roof, because U.S. equities are probably the safest market on the planet right now, other than perhaps gold. We all know sovereign U.S. debt in the United States or Europe is not good, but U.S. equities cannot be confiscated, and there are many American companies that are far healthier than either the European government or Washington, and they offer yield and earnings, even in a slow economy. And like the 1930s, the U.S. market from 32 to 37 became a safe haven, as there were similar protests and social and political tensions rising all over the world, and Europe was going into default. The U.S. equity markets rallied 382% off their 1929 crash low for the same exact reasons. And that's why I'm very, very bullish on equities going forward, and I'm very bullish on gold with or without inflation. So, and most commodities as well. So, to me, the markets now are not about earnings or corporate balance sheets or anything else. It's all about geopolitics and international capital movement.
Larry, let's talk specifically about some of your near-term targets. We've seen a bit of a rally in gold recently off the last few days, up to about 1262. We've also seen, you mentioned, stocks maybe getting a bit more volatile here, looking a little bit toppy if you look at the Dow, the S&P, the Russell. What are your expectations near term for the stock markets first, and then for gold and silver?
Well, near term, gold is still in the process of forming a bottom. Right now, even with the spectacular inflation news this morning, the really wild inflation number of 0.4% on the CPI, which is almost 5% annualized, gold is down $13. That's part of the bottoming process. We could see gold fall down. Short term, it's still kind of bearish, down to 1220, 1210 area, which I believe it will hold. But it's forming a new bull market, and Rome wasn't built in a day. Bull markets get formed over a period of time. So I'm 100% confident we're forming a new bull market in gold. I'm also 100% confident the bottom is already in the mining shares. And it's going to be a little bit of a gradual process over the next few months. The seasonal weakness for the precious metals is this during the summer. So I really don't expect gold and silver to take off dramatically until we get into September, October. Mining shares, on the other hand, they're looking fantastic. As far as the stock market goes, I think we have the first leg down. We'll probably rally up just below the record high on a wave 2 type of correction, and then we'll get a more violent leg down to about 1810, 1770, but that's about it. Then we're going to head up again.
Okay, thanks for those insights. Mike Larson, let's go to you. As if the unrest in the Mideast isn't enough, we've got another market-moving event this week, which is the Fed meeting that starts today and concludes tomorrow, I believe. What are your expectations for the Fed?
That's right, Mike. The Fed expectations, the interest rate level that we have now is absolutely ridiculous given what the economic news is that. I mean, when you have a stretch of jobs figures that are the strongest, over 200,000 month after month since 1999, we have an economy that's growing at 2 to 3%, with the exception of hiccups like the first quarter. And when you have generally rising price pressures the world over, it doesn't make any sense to have 0% interest rates and still, billions of dollars of QE every month. But we got a real shocker this morning from the CPI figures that came out. I mean, this CPI report was an absolute disaster, and it makes a complete mockery of the Fed's ridiculous fantasyland forecasts. You had the headline CPI up 0.4% in May. That's up from 0.3% in April, and it pushes the year-over-year inflation rate to the hottest since October 2012. The core CPI, that excludes things that none of us use, like food and energy, rose 0.3%. That's the single biggest monthly increase in any month going back to August 2011. It pushes the core inflation rate right to the Fed's target of 2%, long before they said it would get there. I was just going through some of the details of the report before this call. If you're buying eggs, they cost you 10% more than they did a year ago. If you're buying bacon, it costs you 15.3% more than it did a year ago. And you know what? Bacon makes everything better, so that stinks. Airfares alone had the biggest monthly increase since July 1999. Medical care was up another 0.3%. So the bottom line is, across the board, the inflation numbers stunk. And I think that puts pressure on the Fed to justify this policy. I mean, this whole idea of low inflation, prices will never go up, the world's going to be in this new normal, we're never going to see interest rates rise, volatility should be the lowest in history because, the Fed's never going to let anything bad happen. And there's a lot of perfection priced into the market, and the numbers just don't bear that out. So I think what's likely to happen, what I'm kind of looking for is a real change maybe in the way Fed signaling happens here. They're not going to come out and raise rates tomorrow, but the outside chance of them going to a $15 billion QE taper from a $10 billion is definitely there, or at the very least signaling that they're going to pick up that pace. And I think that policy doesn't match what the economic data is showing anymore. And given the recent push towards policymakers, not just here in the U.S. but all over the world, talking about the risk of too little volatility, the risk of too much complacency, the need to kind of shake things up. I mean, policymakers are talking about that now, and I think that's, they're sort of floating a trial balloon, but I think it may get may get inflated a little bit more at tomorrow's meeting. So I think we're probably in for some Fed surprises here. If not this meeting, they're going to kind of prep the battlefield for it at the next meeting, like the ECB has done with their policy. I mean, clearly the UK wants out of their overly easy policy. They have a massive housing bubble being reinflated over there. Carney was the biggest dove on the planet for policy. Now he's talking more hawkish. The New Zealand Central Bank has already hiked rates 3 times. Just so nobody pays attention to that, but they're the first developed world economy to start changing the interest rate tack, and I think the UK is probably next, followed by us. So in that environment, I think the Fed's got to take a shot across the bow here, because these numbers are, each number that comes out, including the jobs report, including the inflation report, and so on, makes their policy look that much more and more stupid.
Yeah, it just proves the point, too, what you were saying about eggs and bacon, breakfast going up, that the real things that matter in terms of people's cost of living, tuition, for example, for your kid going to college, or, just about any other cost, medical expenses are going up much faster than the government's official rate of inflation. So
yeah,
we'll keep an eye on the Fed announcement tomorrow, certainly. Let's see. Why don't we go to Doug Davenport in Atlanta. Doug, hi, how are you?
Fine. Good morning. Glad to hear people talking about inflation. I've been talking and saying that this has been a problem all year of inflation accelerating, and certainly a housing slowdown occurring. And I think that the numbers came out today of what was it, minus 6%, or single-family starts down 6%. But I've been talking about inflation and food inflation and rents for individuals, very, very disturbing, and it's been happening since January. But let's get back to the S&P 500, which some of the sectors I look at. Now, if you've certainly needed any reason to sell stocks the last couple of months and weeks, you've had plenty of opportunities to do that and plenty of reasons to do that. But when I look at it, stocks are continuing to climb a wall of worry. And right now, we still, on a technical basis, we have an inverse head and shoulder pattern that still targets 1980 on the S&P 500. Now, that pattern would fail if the S&P were to fall below 1897. Now, if that happens, I don't know. But for longer-term investors, the long-term trend channel since fall or November of 2012, still very positive. Month moving average that you can use for a monthly chart is still very, very positively sloped to the upside. So last week we saw some price pullback. I think it's nothing more than a throwback following the 3-week breakout rally that we've had. To me, it's a buyback rally unless we fall below 1987. And since, I guess, the very beginning of, or middle of February, I've been fully invested in all my equity sector funds that I use for my portfolios. And we've talked about the Fed meeting and Janet's press conference tomorrow. And certainly we want to hear her say that the highly accommodative policy remains appropriate and no rate increases until late next year, but who knows with the numbers today. But let's hope she just doesn't screw up and pull a Bank of England Mark Carney and say that less accommodation is coming, and who knows, the market certainly would pull back at that point in time. Euro, still bearish on that double top formation that formed the last month or so, or even over the last 6 months, I should say. Targets about 133 on the downside, then 132. Gold, which I'm still short, you can look at the support and the resistance, and the support is at 1181 from last June of 2013, and the resistance is around 1434, which was the high back in August of last year. Now, that to me is not in any way, shape, or form a bullish reversal pattern. I expect to see the lows 1180, 1200 certainly looked at again sometime. I have no idea when. But it certainly looks like the institutional investors have been using this recent strength from 1240 up to about 1280 to pull back and to sell their existing positions. Gold's down today, and it doesn't look good to me. It just doesn't look good for gold if you can't get it to clear 1280 to 1300 on the recent events that we've had in Iraq. So range right now 1240, 1280. Key support around 1238. That falls like 1200. Oil broke out last week over 105 out of that 30-month triangle that it's been in. And typically when I put in my weekly commentary that when you get breaks out of long basing patterns like that, then you tend to see some large moves. It doesn't matter what the security is. Now, Russia and Saudi Arabia are very happy with Brent at $113 a barrel right now, and you're not going to find them trying to push the price of oil down. They're very happy. Russia needs the money. Saudi Arabia needs it also. Energy stocks that I use, XLE, it's up over 10% this quarter. Basic materials I use, it's over 5% this quarter. Emerging markets, once again, very strong with China, Taiwan, South Korea, Russia doing quite well. And then you've got the bonds. I've been long bonds about all year. That's up about 11.5% through last Friday. Very attractive TLT, very attractive to own, but you look at the sell-off in treasuries that may continue. This 10-year yield is going to edge up maybe to around 2.64. It gets about 2.65 on my chart. That would probably lead to maybe a trend change, but you know, the higher than expected CPI has it moving up this morning, and with tomorrow's meeting looming large, that any hawkish language from the Fed could provide another catalyst for yields to go up. And let's see, I saw a statistic just a few moments ago that said that the Fed will kick off today's meeting with the highest month-over-month core CPI increase in the last 4+ years and the largest year-on-year headline rise in the last 19 months. So that'll be interesting to see what happens there. But as always, I let the charts tell me where the markets are going. That's the story for this week.
So Doug, you have been long and correctly long bonds, you know, so far this year, which has surprised a lot of investors by being one of the best performing asset classes so far in 2014. What are you looking at, though, in terms of key levels for a potential reversal in the long-term Treasury or TLT?
Maybe 265, about 265 on the yield. And hold on, let's see. I can give you. Let's see, where's that? I'm going to give you a price, which would be pretty important for a change trend. For a trend change right there, the TLT has to probably get to about, well, it's not far from it, let's put it this way, on a trend change, maybe another 1.5 away to where the chart would tell me that it would be time for the trend change and to go short. But as I say, I let the chart tell me, but it's about another 1.5 from where it is right now on TLT.
Okay, thanks for those insights. Mandeep, why don't you bring us home with what you think the impact will be on all this turbulence in the markets, especially for some of the smaller cap, lower price names that you kind of follow.
Hey, good morning, everybody. Yeah, so I iterate the same concerns as everyone else. The inflation number is obviously not very good. You already have consumer that's the largest driver of economic growth, grappling low wage increases, and as inflation picks up, as Mike was saying, 2% year over year, and Doug was saying as well, real wage growth is actually negative, so that's not good. You saw retail sales numbers last week, not as good as expected. What we're seeing in small caps, as well as actually overall markets, you can actually put it on that as well, is the value versus trend divergence. The value guys are largely sitting on cash. Valuations are stretched at this point. You're kind of waiting for a pullback to be able to buy stocks, but the trend following, the momentum guys are the guys that are actually pushing the equities higher, buying into these values, taking markets to all-time highs. And what we're worried about is the air pocket, the divergence of the two. If we get an event or events, we could see a correction that will bring value money back to work, but we need to see growth pick up. And what we saw with the World Bank a week or so ago, and the IMF reducing their expectations for U.S. growth, we're not going to get the 4% handle that some of the economists at the higher end have been expecting for GDP growth for the U.S. Instead, you're probably going to be more in the 2 to 2.5% range. So that's those kinds of things are a little bit bothersome for us. We don't. We're not generally all out long. We maintain a cash position. It's a tough environment to buy and hold stocks with all the uncertainty out there. And you have oil is also another problem for the consumer. Oil prices increasing fundamentally is generally a good thing. It's an indicator of economic expansion and industrials. It's a driver of growth. But when you have the speculation and supply disruptions, things like that, this acts as another, I guess, a harbinger of the consumer potential discretionary income. So that's always not going to be too good for the consumer. It always boils down to that guy. And now we also got a news headline yesterday about the Fed talking about exit fees for bonds. So if you're looking at the Fed now is worried about market reactions, and if you see the divergence in the market, when the market's just continuing to grow to all-time highs, where underlying economics are lukewarm to mixed, 2.5% growth at best, there's a divergence there. So if you get any sign of any fear from the Fed on that regard, that would also be disturbing and probably cause some sort of a correction in the markets as well. So overall, we're looking at the S&P has been above the 200-day moving average for the longest time ever. The VIX, again, is all-time lows, complacency there, and spreads are extremely tight. If you look at CCC rated below investment grade, aka junk bonds, then they're yielding around 5%. That's a long ways off from the 20-some-odd percent that we saw during the recessions. So we're cautious. We're still involved for a melt-up scenario, but we see the risks are increasingly to the downside.
Okay, that sums it up pretty well. Appreciate your insights on that, and I believe that pretty much wraps it up for all of our editors this morning. Thank you one and all for your insights and your observations on the markets, and good investing until next week. We'll talk again. Well, that wraps things up here for this week's Squawk Calls. Great insights, gentlemen. Thank you very much for sharing, and be sure to tune in again next week. Until then, I'm Mike Bernick for Money and Markets. Good investing.